Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. Welcome back to the podcast. I'm Barry Schwartz.
I'm Ernest Wong.
This is the Long-Term Investing Podcast. And Ernest, we have brand new ducks. They finally arrived from the U.S. They're held up a little bit at the border. Are rubber duckies covered under tariffs? I don't know. But
I'm certain they were made in China.
Yeah. Well, I don't know. Anyways, we have Super Warren and Super Charlie, and hopefully they will give us some super results for us and our clients going forward. What does it say on the bottom?
So I've only gone to Berkshire, the AGM once ever, and that was in 2015.
Yeah. You talked about this last time on the podcast.
Yep.
Yeah.
And the ducks that were previously here, they had two styles of ducks when I was there.
Yeah.
And that was the one that I bought.
Mm-hmm.
And this one says...
That was Warren and Charlie in suits and ties.
Yeah, so this one says 2019 shareholders meeting.
Uh-huh.
So I'm curious if every year they have a different duck. If anybody's listening...
Let us know.
Has gone, let us know.
Yeah. So the Super Charlie and Warren ducks, but we also got a couple others, and we'll be revealing those over the next upcoming podcast. And with that out of the way, let's get down to some business. If you like the podcast, the Long-Term Investing Podcast with Baskin Wealth, please subscribe to us on YouTube, on Spotify, on Apple. We'd love your 5-star reviews. We'd love your comments. We always want to engage with our clients and our fans and prospective clients. And of course, Baskin Wealth Management is open for business. We love managing clients' portfolios. We'd love to connect with you, learn more about your circumstance. We're not only stock pickers, Ernest. We're estate planning, wealth planning, financial planning, and we're pretty handsome as well.
Would hope so.
And if you come and visit us, we got a lot of chocolate at the front. So with that, let's get into an exciting podcast. We're going to talk about culture and how important that is for long-term investors. It may be one of the most important things. And we're going to touch on Costco. We haven't revisited Costco in a while, and they're doing some interesting things, Ernest, as their business has grown tremendously since the pandemic. And we're going to talk about the moves they made during the high tariffs, how they adjusted their mix, what they're doing to try and get future growth down the line. Why is the stock so expensive? Do you think it's going to continue to go higher? We'll talk about all these things in our long-term thesis on Costco. A couple of things I want to talk about before we get to that is we've been contacted by a number of clients about the big, beautiful bill, the triple B. And what does that mean for Canadians investors? I mean, we don't have very many U.S. investors, but we can certainly talk about the impact that a lot of Canadians are worried about, which has been in the papers. Are there going to be higher taxes for me on my U.S. and foreign holdings as a result of the big beautiful bill? I would say A, it hasn't been passed yet, so that's no point really talking about it yet. B, it looks like there's an out for Canada to be able to negotiate that withholding tax lower by reducing some tax that Canada has placed on U.S. big tech companies. And C, most importantly, we don't really own a lot of U.S. companies for their dividends. And so right now, Ernest, I believe there's a withholding tax treaty with Canada and the U.S. I believe it's 15% on taxable accounts. So not every single account that you have where you own U.S. securities would your dividend be taxed. And keep in mind, this is your dividend, not your capital gain or an ongoing cost. The income that you receive could be potentially taxed at a higher rate, Right now, I believe it's taxed at 15%. So let's say you get $1,000 a year of dividends from Microsoft. Right now, it's $850 net to Canadians in a taxable account. The proposal, I believe, is to increase that withholding tax 5% a year over the next 7 years to get the withholding tax up to 50%.
Yeah, I think it's not exactly clear
Yeah.
What the rate is going to be or how it is implemented in the end.
Exactly. So we are talking theoreticals here. I guess the worst case scenario is 7 years from now, your Microsoft dividend, which is $1,000, maybe you'll only get $500. Unclear as to that, whether the withholding tax will only be applied to taxable accounts or non-taxable accounts. We don't know. I think I've said it before on the podcast. You should expect to be taxed higher going forward. We know that Canada and the US and all the other countries are sitting on trillions of dollars of debts, and interest rates haven't come down enough to make that go away, and more spending to come in Canada and the US, we expect. So those that have higher wealth should be expecting to see higher taxation going forward, and this is just part of it. As for what we're going to do, we're doing nothing now, but possibility that we could change our portfolio. The final thing I'll say before I turn it over to Ernest is, like I said, we don't buy U.S. stocks for dividends. The bulk of the Canadian dividend U.S. stocks we own pay paltry amounts of dividends, although some of them raise them every year. I don't think the U.S. has a dividend culture like Canada has, because I don't think they have a tax credit that makes dividends more attractive. So the bottom line for us is no changes yet, but we're monitoring the situation. Any comments on the new proposals?
Yeah, I think the thing that you said about how we don't really focus on owning dividend paying stocks in the US is really the key. And not that we ever look for dividends anywhere in the first place, but because of the tax disadvantage of owning getting dividends in the US versus from Canadian companies, that adds an extra layer of incentive to not own those types of companies in the US. So if you are owning a US REIT, for instance, maybe the math may tilt for you to own a Canadian REIT instead.
Yes.
But that's not really a big part of of the portfolio that we have here.
I think if Canadians own specific U.S. income payers for their dividends, I think obviously they would need to think about getting income from other sources, or looking at fixed income or Canadian dividend payers as an offset. But that's not really our strategy. As those of us who know how we invest, we're looking for companies that can reinvest the free cash flows that they generate at high rates of return. Paying out a dividend is not necessarily the right action for a lot of the companies that we own.
Right.
So we've talked about that ad nauseum, and if you want to check out a podcast where we talked about yield, I think that's two or three podcasts ago. I can't remember what the title is, but you should check it out. We're not yielding for yield, something like that.
Yeah.
Another thing I want to talk about, I'm just pulling this one off my head, I'm going to blindside Ernest here, is are people drinking anymore? We've seen the results of Brown-Forman, Diageo. When I started in the business, it used to be buy companies that, drink them, smoke them, eat them, and whatever makes you look good. Those are the businesses that you wanted to own, right? So makeup companies, healthcare companies, food companies, cigarettes haven't done well until recently, but all the other ones, there's issues, right? You see some of the makeup companies like Estee Lauder having a really tough time. We've seen some of the food companies like Pepsi and Hershey's. Their stocks have done very lousy recently. And now the alcohol companies. Your take, Ernest, on what's going on with these consumer companies? Are brands losing their luster?
Well, I think there's a lot of things going into that.
Yeah.
And it's kind of hard to specifically attribute one,
of course,
cause as the main driver of the poor results. I think the biggest factor for the entire food and staples industry as a whole is that COVID was such a weird time that going into we're just coming off during COVID, everybody was stuck at home. Everybody had a lot of money because of low interest rates and the stimulus and all those kinds of things, and everybody was stuck at home. So they were eating chocolate, they were drinking alcohol, they were doing
Watching Netflix,
watching Netflix,
and getting fat. And now that we have Ozempic and GLP-1 drugs.
And I think that we've talked about this before, where a lot of these companies used the volume spike during COVID and the subsequent inflationary period to raise prices to a point where today, and I think what the reality for many of these businesses is that they're just not really growing businesses to begin with. And in chocolate consumption, for instance, like I think I've looked at this before. I think chocolate consumption per capita hasn't grown for 20 years. So just because you had this one period of time when the business grew spectacularly and prices were able to be increased substantially doesn't mean that you should be able to expect that going forward. And it's not, and I think if you listen to a lot of these, what these companies are saying, they're saying the low income consumer is struggling, which may or may not be true. I don't really have an opinion on that. But I think it's also a mistake to go back and say you should expect that growth is going to reaccelerate back to what they were during this extremely weird period of time. So I think that's kind of the big picture of what's happening with some of these companies.
I think anecdotally, if you talk to people, many will say, I'm drinking less. There's more options for those that want to party, right? Marijuana is now legal in many different provinces and states, and that's an alternative. The price of alcohol has gone up. The price of bag of chips has gone up, right? So people are rejigging. And then, of course, there's these headwinds where people are getting healthier. Thank goodness, right? Or maybe on some of these weight loss drugs that are curbing demand. Too soon to tell whether that all comes back or behaviors change or how these drugs will continue to adapt and improve and continue to change behaviors and become safer or not. Hard to know, but this is investing. You have to pay attention to the trends. And one of the things that we're looking for when we buy a stock is we really want to buy companies that can compound the rates of return by double digits. And one of the things to look at is the top line. If the top line, the revenue line isn't growing, you're facing competition, you're facing so many other variables that are affecting your business. It's pretty hard to grow your bottom line 10% when your top line is only growing 1 to 2.
I think with the GLP-1 drugs like Ozempic, I think Restaurant Brands had a good. They did a little bit of math on this topic where they said if you assume that 20% of Americans are using Ozempic, and they reduce their because of using Ozempic, they reduce their calories intake by 20%.
Okay.
Then that leads to a 4% reduction in overall industry calories consumed. And so is 4% a lot? Like it's not nothing, but it's also not like sales are going to zero.
Yeah.
And so I'm probably a little less concerned about the impact of these drugs on the fast food industry or things like chips. But I would be a little bit more concerned about the alcohol industry, because in the alcohol industry, I don't know if people know this, but there's this crazy stat that I think 10% of the population consumes like over half of the industry's alcohol.
Not me.
And I would, if I had to guess, I would probably assume, I would probably think that 10% is more heavier than the other 90% of the population. So it would, to the extent that Ozempic reduces alcohol consumption, I think it would disproportionately impact the alcohol industry as opposed to something like Tim Hortons.
Yeah. I mean, just anecdotally speaking, you go for dinner, you go to a restaurant, you want to order a cocktail, a glass of wine, a bottle of wine, the prices are insane. And when you and I were kids and we went to bars or we bought alcohol, it's a lot cheaper than it is today, right? I have two teenagers. No question, they try alcohol. It's so expensive that they don't. They would rather have fun at home first. So it's interesting how the world is changing.
What does that mean?
I'm not talking about that. So let's move on to talk about culture. It's such an important factor. We always say to clients, over the long term, what matters isn't if a company's going to beat its quarterly earnings and you should buy the stock. What matters is the management, the culture of the business, the durability, the incentives. These are the things that essentially drive all behavior. The management have an owner-operator mindset, or they're just playing with the house's money, so to speak? Does the board of directors have a skin in the game, or do they not care? It used to be in the olden days, right, when the Romans built the bridges, that they put the engineer or the architect underneath the bridge and let people and stuff go over it, and if it collapsed, you're going to die. So skin in the game to us, what I'm trying to get at, is such an important thing. I always tell clients that the stocks we buy for them, I own them too. I want to feel the pain as well as the rewards of any of the stocks that our clients own. I'll never buy an idea for a client without at least buying a position for myself or my family. It makes no sense. So skin in the game to us creates an alignment between the shareholders, the employees, and all stakeholders. And Ernest has got a few comments to talk about in terms of culture and incentives.
So I think that it's important to keep in mind when we're talking about culture that the ultimate objective when you're trying to pick a stock or manage a portfolio is to make money, right? It's not.
Is it? Shocking. Yeah.
And I think people don't talk about this enough because a lot of time, like I think a lot of people equate culture to some kind of fuzzy feeling that you get that has, for a company that has good vibes, right? But I think from my perspective, when I'm looking at a company's culture, what I really care about is, well, first of all, like, we only buy good businesses. So that's the first thing to look at.
Yes.
But the important thing, if you own a good business, is the money that the business is making going to end up coming to us as passive shareholders.
That's right. I think a lot of people forget first principles of investing, and that is the goal of management, the board of directors, is to maximize profit for shareholders. So when you're buying a stock, there should be incentives and alignments all the way down the chain to drive results for profits for the shareholders. That's what it's all about. Why else participate? Why the hell am I buying shares of a company? For ESG or to make me feel good that I have a stake in that company? No, I want to make money.
No, and I think there's a lot of businesses, especially in the US today, where you can do all the work you want to do about the business and why they have a competitive advantage, why they're gaining market share over somebody else, why their products are better than the next competitor. Mm-hmm. But in the end, like, the real question is, are you going to see any of that as a shareholder? Mm-hmm. And the way that I think a lot of American companies are set up today, and I think part of this is due to the capitalistic nature of how American society evolved, is that you have these kind of big board of directors. They're all appointed by, like, they're independent, but they don't really have much skin in the game. Like, they're just kind of hired to oversee the company. And then you have the CEO, who was, again, like, he may have gone up through the company or he was hired by the board. Mm-hmm. And at the very top, at the shareholders, is, you see maybe 50 or 60% of the shares are owned by ETFs, right? Like Vanguard or BlackRock or State Street, where not that they don't care about what's going on in these companies, but they own everything. So they're not,
and they're buying, and because of the liquidity of those products, there's the shares that they hold change minute by minute, right?
Right.
Unlike Baskin, where we may buy a position and increase it over time, An ETF they're not making that necessarily that decision by themselves, right? It depends on the inflows and outflows of their customers.
And so when you have this kind of situation where nobody along like any of the process, there's nobody at any layer of the company who actually owns a material portion of the stock as their own net worth.
Yeah.
Not that they're acting nefarious in any way, and I'm sure that these people are trying their best to do what's best for the company, but I just don't think you act the same way as you would if it was actually your own money.
Yeah.
So
that's why we love, for example, Constellation Software.
Right.
Right. Constellation makes or wants their employees to buy shares of Constellation. Here's your bonus. Use it to buy shares. Have skin in the game. And for those early shareholders, employees of Constellation Software, I mean, many of them are multimillionaires as a result of what management, the incentive plan that management set up.
No, and I think studying the incentive, like I think Munger was the one who said that like you should look at the incentives
first. His line is, show me the incentives, I'll show you the outcome.
Right. And I think if you look at, sometimes companies will do all sorts of weird things where, like, let's say this company goes and does this really expensive acquisition and you're like, what the heck? Why'd you do that? It usually is because the CEO, like he doesn't really own very many shares. The board doesn't own very many shares, and he'll go and present it to the deal to the board and make strategic sense, but it's not the deal that you would do if it was your own money.
Correct. And also there may be an incentive where the CEO is, or the management team is compensated based on certain metrics, right? Earnings per share growth, or total return of the stock versus peers or the S&P 500 or whatever the heck it is. But more importantly, we'd love to see, okay, you're compensated because you have the alignments with the rest of the shareholders and you're going to make a ton of money doing the right things over the long term, and the shares are going to go up and everybody's going to be happy. Very few companies actually follow that discipline.
Right.
And, handing out shares to board of directors and people just getting paid to chum around. These are not the companies we want to be invested in. Sometimes we do own them because some of their business characteristics of the business is so good, you have to own it. But, I guess the bottom line is there's no perfect company. But do you have a few companies you want to name that or give some examples of some incentive plans or culture that, you're really impressed with?
No, so I think in Canada, for whatever reason, you do see these situations where there is a large controlling shareholder at the top. Maybe it was the founding family. They still have seats on the board.
Yeah.
And their shares in the company are the majority of their wealth.
Okay.
So I think one really good example is you mentioned Constellation Software. Canadian Natural Resources is another one where Murray Edwards, he owns the largest shareholder of Canadian Natural, and it's the bulk of his net worth. Like he owns other stuff, but like it really matters to him whether Canadian Natural Resource stock goes up or down.
He's probably a billionaire, and so it's very meaningful to his family's welfare. Mike Rose is another one, right? CEO of Tourmaline, significant stake in Tourmaline Oil, and continues to buy more shares on dips in the stock, right?
And you can really tell the difference when you talk to someone like Murray Edwards. Like he really cares that whether the management is careful about the cost structure of the business, right? Because it's his money.
Yeah.
Right. Whereas I just don't see that same level of discipline among these companies where everybody's independent and nobody has meaningful skin in the game.
I love the ownership culture. Companies like TransDigm have it, Heiko has it, Constellation has it. Just that mindset. And once you find a few of those companies, that's where you start digging, and the patterns get recognized, right? It's not easy. Companies want to reward employees. They have to always fight hard to keep employees. There's always disruption risk. You want to hire the best CEO. That doesn't necessarily mean he or she was a founding person in the company. But we would love to see more incentive and alignment plans with top management owning shares and not being allowed to sell those shares, and honestly not being gifted those shares either as their comp, more using bonus to buy stock. And I'm an owner of Baskin, you're an owner of Baskin. We don't want dilution. Only
You
if
can
it,
give me shares though.
yeah, and I'm not. But but dilution without any offset of acquisition or something is just terrible for the remaining shareholders. I would like to see the opposite, where I own more for doing nothing, and that can happen with a lot of publicly traded companies who buy back their stock and reduce shares outstanding. If you own 1%, and 10 years later now you own 5% of the company, and all you did was just sit there and collect the fact that you're getting a larger ownership in the shares. It's wonderful.
Nah,
Waste Connections also has a terrific alignment and culture.
I think the opposite is not true as well, though.
Yeah.
Just because you have insider ownership of the stock doesn't mean it's a good company.
No, treat you.
And you see this mistake a lot, where you see, like, especially, I'm not going to make fun of anybody, but you see these write-ups for these small cap companies where it's like the CEO and the chair own like 50% of the stock.
Yeah.
But it's not a company that you actually want to own.
So what about Ernest? I'm sure someone will say, okay, well, I see Mark Zuckerberg has been selling billions of dollars of Meta. Bezos has been selling billions of dollars. Shouldn't we also look to sell if they're looking to sell? What do you say to that when you see big founding shareholders liquidating their positions over time?
Well, I think those two specific examples are maybe a little bit different than the average company, because Bezos and Zuckerberg are so unfathomably wealthy that that it almost, to them, like selling $2 billion of stock is just play money.
Fair enough. Yeah.
And the bulk of their wealth is still in practice aligned with is still aligned with what they want to do. And maybe he wants to make a donation to some cancer society or whatever.
Yeah. Or buy a new super yacht.
Yeah, but I think that it doesn't bother me too much. I think a bigger question for those kinds of companies is, at a certain level, I think your motivation no longer becomes, do I make more money?
Yeah.
And it becomes something else, whether it be like, am I inventing artificial general intelligence or something like that? And I'm not saying that you should sell those companies, but it is something to think about. Yeah,
no, there's more to think about, Ernest, than just PE and dividend yields and other ratios, fundamentals. It all goes together. And to us, as long-term investors, the most important thing is the capital allocation, the culture, the incentives, the skin in the game with the management team. We've said it a million times ad nauseum, but I think you get the point. So Costco is thinking of extending its hours. Did you read that?
Yes.
Apparently, I've never filled up gas. Have you filled up for gas at Costco?
No, the lineup's always too long.
Yeah, so no, but that's a Yogi Berra joke, right? The lineup's too long, nobody goes there, yet the lineups are always too long. So I read that they're looking to extend the gas filling hours from 6 a.m. to, I don't know, God knows what time at night, and also open the stores an hour earlier and close them an hour later.
So I think the store hours was not officially announced by Costco, but they had kind of hinted at it at the earnings call, and there were rumors that they were going to do it.
Yeah. Some people tell me that even though Costco opens at 9, sometimes they get to the store at 8:15 to beat the lines, and the store is open anyways.
Oh, is that right? I
don't know. That's an anecdote someone told me. Please don't go to your Costco tomorrow morning at 8:30 hoping it's going to be open because Barry told you. But Costco, Ernest, the results continue to be quite strong. I think it reported 6% same-store sales growth. A part of that, of course, is people just buying gold bars, which seems to be a huge part of Costco's business right now. And with gold hitting multi-year highs, that's obviously, we enjoy that part. With the worries about the tariffs and the potential higher prices for food and goods, maybe people were doing some hoarding, as well as maybe they're getting better value buying more. We're seeing how many members they have now? 80 million?
Yeah, I don't have to figure it.
Yeah, it's quite large. and growing there. Costco recently increased the membership price. We think they have years and years of growth in that department. But what's your take on what's going on with Costco lately, and any updates you want to share with the podcast listeners?
So I think Costco is one of those businesses that I think everybody knows it's a great business, but I really don't think it's recognized how awesome of a business Costco actually is, especially among the investment community, because I think most people just look at the PE ratio.
Yeah.
They see it's 50 times earnings, and then they don't really bother to even follow the company even further because maybe it's not an actionable idea.
Can I tell you that my biggest errors over the years is saying, I'm not going to pay 30 times multiple for Dollarama.
Yeah.
I'm not going to pay 35 times earnings for Ferrari. I'm not going to pay up for Cintas or all these other companies that just have compounded at tremendous rates. You said the other day, the Constellation software, the valuation's gone up a little bit, but it's quite similar to where it was when we bought it nearly 10 years ago. So,
and I think to that point, I think I've personally found it a more fruitful use of my time to study businesses where everything is going very well, and the only reason you don't want to buy it is because of the high valuation, as opposed to companies that are doing poorly and everything is going bad, but the valuation is cheap. So,
but there is obviously a limit to valuation, and we all remember, or those that are in tune with finance, the Nifty 50 conversation, where the best loved glamour companies in the 1970s got to 80, 90 times earnings, and people were paying up, even though these were good, profitable businesses. The interesting thing, and we talked about it before on the podcast, is if you would have held that basket till today, you would have outperformed the S&P 500, just because one or two of them probably did tremendous. Many went bankrupt, of course. That's just investing. But where was I getting with that?
No, I think that I can beyond Costco, I can talk for a long time about this topic.
Yeah.
Because I think that so many investors have conditioned themselves through, following people like Warren Buffett and other great investors in the past, where they're just so conditioned to look for bad companies trading at low multiples. And I think the effect of that is that over time, the markets have evolved, right? Where before, value investing, quote unquote, value investing actually worked because nobody was looking at these terrible companies.
Yeah.
And there was actually some value in them, to a point where now every company that trades at like a below market multiple is studied ad nauseum by the investment community. Mm-hmm. So I think part of the reason why some of the names that you listed have worked so well is because
no one's buying them because they're too expensive.
No one is buying them because they're too expensive.
Yeah.
I think I think you have to be humble about and reasonable about kind of the valuations that you may end up paying for these companies. But I think the flip side, just merely expecting that low PE stocks are going to outperform just because they have in the past, I personally think that time is gone.
I can't say, Costco's $1,000 a share. We're not going to toot our own horns and think we're geniuses. But all I remember is when we bought the shares and it doubled to 500 or 600, the comments were exactly the same as what the price is today at 1,000. Stock's overvalued. I can't believe people are paying this multiple for the stock. It's going to end in heartache. Right. So they're not speaking. They're just speaking about the valuation, but without giving any evidence as to, okay, not talking the bull case about Costco, what wonderful things can happen. Why is it, I'd love to always talk about with Ernest, okay, once we finally look at a company, we look at the PE, like, okay, why is it trading at that PE? Right. What's the rationale? Great businesses don't trade necessarily at low valuations. Those two things don't go together, especially in this day and age where all the information is accessible by you and AI in a second. So it's hard to get awesome at cheap. It doesn't necessarily happen. Obviously, there's a risk at where you think the company's awesome, but you're paying the stupidest price and you are at risk. And bad things can happen to any one company at any time, right? Costco, I mean, its chickens could cause a salmonella and no one shops there for a while. That you know, anything's possible.
Right. No, so I think for Costco, I think the impressive thing about Costco is that they continue to report these amazing same-store sales growth. I think a lot of people thought during COVID that this was a one-time bump. You know, you couldn't shop anywhere else because they were all sealed up or whatever.
Yeah.
And so everybody had to stock up on toilet paper. Do you remember that?
Yeah. Toilet paper is important part.
Yeah.
Yeah.
But it turns out that following that, Costco is still growing like 5, 6, 7% same-store sales growth per quarter. Well, not year over year.
Yeah.
And
if it was going per quarter, we wouldn't have this argument about 50 times earnings. Yeah.
And it shows no signs of slowing down.
Do you think part of it has to do with once you buy a membership, you just tend to use it and want to get value out of it? And so the membership has grown. I don't know if it's 80 million today and it was 50 million in the pandemic, whatever that number is, throwing it out there. You know, that just leads to more repeat business. And obviously the Costco gets high KPIs, high survey scores on the experience people have, or they wouldn't keep going back there.
Well, I think Costco is one of those businesses where it's a classic defensive company where they do well in good times because things are good, but then they do really well in bad times because they are the cheapest place for you to be able to buy like all these daily necessities that you need. And I think the real key about Costco's business model is that
hot dog and the Coke is really
no, and there's
necessity.
like 1,000 things about Costco that we could talk about. But I think really the key is that they only have two, like for ketchup, let's say, there might only be 2 brands of ketchup on the shelves. One might be Heinz and one might be Kirkland Signature ketchup. I don't know if that's a thing, right? So the reason why that matters is because, and we saw this during tariffs, is that if something happens to one of the suppliers, right? Let's say Heinz says, we want to raise the price of the ketchup. Costco is able to say to Heinz, okay, if you do that, we're going to switch to French's. And we're just going to stock French's throughout all of our warehouses where 80 million members are only going to be buying French's ketchup instead of Heinz today. And so Heinz, you know, to some extent has no choice.
They have to acquiesce to the demands of Costco.
And this is exactly what happened during the tariffs, where Costco can have the ability to switch things. Sometimes maybe even switch it completely. Like, so instead of having, you know, sandbox toys made from China, switch to, I don't know, like chalkboards made in the US, right? And instead of buying sandbox toys from China, now all the Costco members are going to be buying the chalkboards. So it's this ability to continually manage the inventory that they have to save money for the members, which is why the business model is so powerful. And I think that as they get bigger and bigger, they find more ways to be able to flex this. So for instance, like, I don't know if you knew this, but you can buy like Air Canada gift cards at Costco.
My sister buys Uber gift cards and saves a bunch of money. So if you're willing to prepay for Air Canada or Uber or whatever, you can get, what do you save, 10%?
So it's $500 gift card, and you pay $450 for it. So you save $50 for just buying it through Costco.
That's right. So smart people save a lot of money, but it's hard to shell out. I don't know when my next trip is, or I don't want to sit on this, and I could use the money for something else. So that's a game that people have to play, the odds, whether it's worth it or not. But certainly being able to buy $500 for $450 sounds like a good deal.
No, and that's really the key for Costco, is that companies and suppliers like Air Canada are going to do this because they're actually going to be able to sell more tickets because of their presence in Costco. Whereas nobody else can do this. Like Air Canada can sell gift cards on Amazon, and you know, like, it's just free money in the end to the customer that doesn't end up providing any value to Air Canada.
There's billions and billions of people on this planet, right? Costco is only right now engaged with 80 million of them. The world's a big place. We see that Walmart, for example, has 10,000 stores. I think Costco has 800, 900. Not saying that we'll have Costco's in every city in the world, but there's potential, and you don't know what the next iteration of Costco will be. Maybe more e-commerce, maybe they'll have more targeted stores, maybe they'll have smaller stores. There's just a big backlog of things that they can do to get growth in the future.
I saw a tweet that they were experimenting with furniture stores.
Okay.
I have no idea if it was, maybe it was AI generated.
Yeah,
it might be fake,
maybe.
but I think,
Well, there's a lot of empty real estate
yes.
space, right? There's been the bankruptcies of Bed Bath and Beyond. I'm blanking now, but there's been a lot of retailers, especially in Canada, going bankrupt. There's room for companies to try some interesting things to get market share and take advantage of the empty space and large spaces that are available. And Costco knows how to run a retail business. That's 100% sure.
No, and I think the inevitable question then becomes like, yeah, sure, what you said is all nice and fine, but is it still worth 50 times earnings?
Is it still that's the $1,000 question on Costco stock?
And I'm going to dodge the question a little bit, but I think the thing that's not appreciated about Costco is that Costco can decide how much it grows at.
Yeah.
Right? Like because of the way that they have the membership, the way that they can push products out to the customers at the pace at which they open new stores. The growth rate that Costco can grow at is just basically what they decide it to be.
It's very similar to the Ferrari thesis,
yes.
right? Costco is going to open up one less store than what is it, to meet the demand?
One less car than the market demands.
So one less store than the market demands, and that's why the stores are busy. And there's, in our opinion, there's decades of runway growth. And unlike a lot of other businesses, the Costco business model seems to work very well in every single country, right?
Yep.
People seem to like the value approach, the treasure hunt, the high quality goods that Costco offers, the experience. I don't know. I don't like shopping in Costco.
They have like tour buses that go
exactly.
to Costco in China.
And the food, for some people, they love it, the fresh prepared food. And targeting different ethnic groups and cultures, what they're looking for. So, Costco is a gigantic monster. The valuation, it's high, but you have to determine whether you think you can earn a decent return over the long term and what levers and drivers Costco can do to continue to keep this growth. Will it grow will the stock triple over the next 5 years? Probably not, but no one knows.
Right.
And, we still see enormous value in that business model, and it ticks the box. We talk about culture and incentives. Talk quickly about the culture at Costco.
Yeah, so Costco, I think, is the best expression of what, like, the best aspects of free market capitalism that exists, where you have a business that uses its scale to lower prices and gain market share over competitors, and by lowering prices for consumers, by selling more of their suppliers' products.
Yeah.
And because it's so efficient and doesn't really rely on marketing, it's able to run with way fewer employees, so that all of its employees are paid. I think the national average in the U.S. is $30 an hour today.
At Costco.
At Costco. So
that seems much higher than the national average, yeah.
Yeah, so customers do well, Costco does well, the employees do well, shareholders obviously have done pretty well on the stock. And so it's one of those businesses where I think it ticks all the boxes, to your point.
Yeah. Is there anything about Costco that concerns you? What would, aside from valuation, valuation is a risk for every company. Are there any risks that you see with the story in terms of the business, or anything that you think the business would need to improve on?
Well, I think the criticism on Costco before was that it was not adequately going to be able to respond to Amazon, and that they have been a little bit slower than you would have hoped with e-commerce initiatives.
Fair enough.
But I think they've really picked up on that a lot lately. They have tools at their disposal to be able to grow their e-commerce business. So like
Well, they
today,
partnered with Instacart right now, right? For
yes and no.
okay,
Yeah, you can buy Costco on Instacart,
yeah,
but they also have like a large e-commerce business, which like some of this is gold, but they sell a lot of appliances and is still growing double digits.
yeah. We
They
bought a reverse osmosis water purifier from Costco. They didn't install it; they use a third party. But you get it. We got a good price. We got great service. Can't complain. We ordered. My brother-in-law ordered kayaks for his cottage. You know, the service, it was white glove service. They brought the kayaks. They actually got rid of the garbage. I mean, these are things that your
yeah
Amazon delivery person doesn't do.
yeah
Uh,
no, and I think that's the area where there's still a lot of things that Costco can do in e-commerce. I don't know how big it'll end up being because they still want you to go to the store at the end of the day. But like another thing that they're doing is I think they started selling ads on their website. Not and again like not like Amazon where it just goes to their bottom line, but they're using that to lower prices for customers.
and we didn't even talk about all the other services that Costco offers, right? Eyeglasses, hearing, travel, gasoline. You know, they really have a nice target on the boomers and that population. How is Costco doing with the Gen Z and the millennials? Are they shopping there as well? Are they seeing the benefits of a Costco membership?
Yeah, so that was another thing that has been a bit of a concern for analysts over the last little while is as like younger people are starting families later and they
Yeah.
don't need like 4 bottles of shampoo every time they buy shampoo.
Yeah,
Like
and people are having fewer kids, right?
yeah,
So instead of three, they're having two. Instead of two, they're having one, right?
yeah.
Yeah.
Like so is there still a need for the Costco business model? And no, I think they've been pretty consistent over the years where at first they were a little bit worried about that, but today they find that younger people are signing up to the same extent that
Beautiful.
prior generations have in the past. So, and I mean, some of this is due to like some of this will end up being like the management's ability to find things that appeal to this generation. So,
Anything else you think Costco's working on, or they've been talking about in their conference calls, or that to improve the experience, or adding more services aside from the e-commerce that we mentioned and longer hours at the stores?
one thing that not a lot of people are talking about is there is this thing that Costco launched called Costco Next. It's basically like a marketplace where you can shop at some of their vendors directly. So Costco is not the one like you're not shopping at Costco, but you're shopping at this Costco site to the vendor and to buy I don't know, electric scooters or
Kind of
whatever.
similar to Amazon Marketplace, Amazon third party, right?
Yeah,
Where
but the difference being that Costco has no role in the transaction
okay,
apart from just facilitating the order of this for facilitating that order.
but it's getting revenues obviously from advertising or
Well, I think
yeah.
they get a cut out of
Beautiful.
providing the distribution. No, not even distribution, providing the shopper.
Yes,
Right?
and so people would buy it on their Costco credit card or what have
Yes.
you. Any other points we didn't cover on Costco?
No, and I think that's interesting
Okay, yeah,
because
okay.
the reason this is interesting is because I don't know how big this thing is going to be, and they keep saying it's growing every quarter.
Yeah.
But to the extent that this grows bigger, I think that could be, like another way for Costco to extend their brand membership benefits in a way that benefits its members, doesn't cost Costco anything, but allows like the members to save money.
Anything you can, they want repeat business. They want people coming into the stores. They want people going back to their websites, reordering, thinking they're getting great value, great customer service. The culture, the incentives, it's all there at Costco. We've talked about it. Focusing on the customer experience is probably another most important thing that companies need to do. Provide the best they can, have all the employees and the stakeholders engaged and remembering that if you don't have a customer, you don't have a business.
Yep.
So in the next couple of weeks, we're going to introduce a new name to our portfolio. Ernest, we haven't been very active this year. I talked about it on the last podcast. but we finally made our first large swap of the year. Hoping it works out. We're excited to talk about it. I'll give you a little teaser. It's something to do with technology, and so we'll hope. And it's not a U.S. or Canadian name.
No.
No. So we'll talk about that in the coming weeks, reveal that, and looking to take more of your questions and whatever else we come up with. So with that, we wish everybody a great start to the summer, and we'll see you back here real soon. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.